rather than this very sharp slowdown. I think what we still don't know is whether the oil exporter policymakers now really do get it, that their future growth and the oil prices will stay low, probably significantly below $50 for the next couple of years, whether this really now drives them to structural reforms, to open up their economies, to remove petrol price subsidies, to raise non-oil revenue, all these structural factors. The key will be over the next few years now whether these gain momentum.
I mean, just given the current occupants of Aso Rock and the current people in charge in Nigeria, there is a fairly strong ideological stance against that. You just have to look at the way they see trade in terms of economic nationalism, the closure of the border with Benin. Do you think they are likely to suddenly flip and go with a much more, even if it's an IMF light, liberalized package?
I don't think they're likely to flip. No, I don't expect. I don't expect the president of Nigeria to suddenly completely turn into a right-wing free marketeer and start proclaiming the opening of markets and the devaluation of the naira. And, I'm saying that probably they'll get around to the devaluation of the naira at the end of this year. But one of the things I've made in this is that I think that Nigeria is running into an economic reality over the next few years. There's some very big signposts of that. We know that Africa's richest man, Mr. Dangote, is building a new refinery in Africa. And we know that probably the only way that's profitable is if Nigeria liberalizes its petrol price. So therefore, I think that, this is a good opportunity now with the oil price low to liberalize the petrol price and allow that to happen. Mm-hmm. Similarly, people are going to wake up and say, well, look, you need a hospital to run in Nigeria. We need a regular electricity supply to run. There are up to 10 power plants having been built in the Niger Delta in the last few years. The problem is that the price paid by the discos, the companies that distribute electricity in Nigeria, is wrong, and they can't agree a gas price to supply the plants. So the point I would make is this is the environment that you actually have to make these difficult decisions. So it's not like I expect a rapid change around, but what I'm looking for is a certain amount of signposts along the way that take me forward. Secondly, I do still have some faith in the belief that, Buhari is now a second-term president. His term will run out in 2023. And if some of those harder decisions are pushed upon them, it's not him who's going to benefit, but it may well be the next presidency. But I accept this is all very much out in the open. We don't know. One thing that gives me a degree of comfort in this a little bit is that if you looked at our previous oil price forecast for somewhere like Nigeria, what they would show you is that we had a gradual decline in the oil price down to $45 in 2023. And what I know is that when oil prices are gradually declining, there is just no impetus for reform in Nigeria at all. Whereas what we've had now is this collapse in oil prices. And if that low price stays now, it will much more quickly bring into light all these problems in Nigeria and force them into having to think about ways of solving some of this thing. And I think in the end, practicality might well trump ideology in Nigeria.
Fantastic. I'm going to sign you up to our Silver Linings Club we're starting at the Africa Report. Where do you expect the dollar naira rate to end up?
I have a 475 end of year forecast at the moment. I'm not going to pretend that there's much science attached to that in this current environment. It depends where your oil price is going to end up and how your current account adjustment funds through. And, if you said to me, oh, well, I've heard various, I would say a range of 450 to 500 is perfectly plausible. If you want some science behind it, if you do a quick calculation, and you looked at when the NAFEX rate was introduced, and you look at Nigeria's inflation differentials between its main, between the US and Europe and Nigeria since the introduction of NAFEX, that would point you to a level of around 465, it should be. But that also depends whether you believe PPP, purchasing power parity, matters in Africa, or Nigeria in particular. I would say it does matter in Africa, but not necessarily in a petrocurrency like Nigeria. But it's that sort of range, which I think is less brutal in terms of an adjustment than we saw last time round.
Staying with our final major oil price exporter, we've heard that the IMF is probably going to have a second program in Cameroon, Congo, Gabon, probably some liberalization there. Angola is already in this IMF program. Nigeria applying and likely to see devaluation by the end of the year. Will Algeria explode? They've been fighting against devaluation, burning through their foreign exchange reserves since 2014. Now foreign oil companies are looking to exit. It still looks very, very fragile politically. These foreign exchange reserves are dwindling, but they still prop up the dinar. But at some point, I imagine they will be forced to devalue, and that may well have big political ramifications. Do you think Algeria might be in your second scenario, where the virus, interacts with these kinds of issues, and suddenly you may get huge inflation, and that interacts politically, and you start to get maybe not a meltdown. I totally agree. We should be as little hysterical as possible in these things, but it does seem that Algeria is facing some pretty unenviable choices at the moment.
No, I mean, I agree with you. Algeria obviously has a high level of cases of COVID-19 in the African space. And look, every country has a reserve cutoff level, is how I put it. So, Nigeria's is around 25 billion. When foreign exchange reserves fall below 25 billion, ultimately they give up the ghost and allow a devaluation. Angola's was around $15 billion. You can pick your level. So we know that Algeria's foreign exchange reserves have fallen from 198 billion in sort of mid-2014 to current levels. They don't publish them so up to date, but I would suspect that they're around 60 to $65 billion at the moment. And yes, you would say that their cutoff level probably is somewhere around Nigeria, somewhere between 25 and $30 billion. If they allowed FX reserves to go below that, they would be entering a very difficult terrain. So they can probably make it through the rest of this year. Obviously, they could drag that out quite a little bit, rather like Nigeria having been able to access or being able to access money through various facilities, the rapid disbursement facilities from the IMF, maybe World Bank borrowing. It's possible that Algeria could also access some of those, and because it hasn't really drawn them down historically, it would be able to get quite a significant amount of money, and therefore that might buy it a little bit more time. But I do agree with you in that sense, and that would take me out of your silver lining club, is that I think you do in the back of your mind have to have this worst case scenario. And the worst case scenario is that COVID-19 gets into an African population. What you then begin to see typically in Africa is that population starts to store foreign currency, or the economy effectively dollarizes. And if you're devaluing the exchange rate and the economy is dollarizing, that devaluation becomes very brutal. And in somewhere like Algeria or even Nigeria, yes, that can then start to really spill over into significant inflation. The thing I always stress to people is quite often, I think, as political analysts, what we tend to think about is like elections, big set piece political events. When I sometimes say to people, it's little triggers that can sometimes really cause unrest in a country. So, we go back to the Arab Spring and have that Tunisia's, Jasmine Spring was driven by a vegetable seller setting fire to himself. I think in Nigeria, for example, the little catalyst would simply be this growing acceptance that someone like the president's chief of staff actually contracted coronavirus when he was in a foreign hospital, probably in Europe, we believe. And then, they're all suffering because there's no healthcare facilities. I'm not sure what the little trigger will be in Algeria, but I suspect it's always that sort of little trigger that could potentially drive it. And, obviously with the rate, the size of the protest we saw that led to the downfall of the Bouteflika regime, it is very, very difficult for them in the coming months. So yes, I do think that Algeria potentially could be a source of concern. The question which we sort of came in on is really how long is all this shutdown going to last? If it's only 3 or 4 months, the Algerians will easily ride it through it with their current level of foreign exchange reserves. And even afterwards, if things don't recover quickly, they will still probably be able to get market access, borrow more money and manage their way out of it in that respect. But if it lasts for another 9 or 12 months, yes, I think there is a potentially a very big time bomb in somewhere like Algeria. But I think we could say that for a number of African countries.
Many African governments borrowed heavily in recent years. Some people are already talking about debt forgiveness or debt repayment moratoriums. But while the big recent debt forgiveness period for Africa, which was launched in the mid-90s, the HIPC process, was relatively straightforward. Any debt forgiveness this time around, if the continent needs it, will probably be much more complicated just because of the structure of the debt. It's much more commercial debt nowadays. First of all, do you expect any debt distress? And how might this new changed structure of Africa's debt play out?
Yes, I mean, so what we've seen is this proposal from the ECA. So it came out of the Economic Commission for Africa so the Economic Commission for Africa estimated that Africa needed $100 billion fiscal stimulus, which is around 3 to 3.5% of GDP. And their initial proposal was that could be raised by having a moratorium on debt interest payments in this year, 2020, which they believed could raise around 44, I think, billion dollars was the number that they brought up. The IMF seemed to run with a little bit and seems to have said there could potentially be a moratorium on bilateral debt repayments. Whether you would then include multilateral repayments, it's not clear to us, and whether Eurobond holders, which are the main source, would be included is also not clear. Now, if you only have a moratorium on bilateral repayments, the big beneficiaries are actually Africa's poorest countries, people like Sierra Leone, Liberia, Guinea, wherever you like, these sort of smaller poor countries. If you go back, so when we think about Ghana, if you look at Ghana's external debt stock at the moment, around 50% is commercial debt, i.e. Eurobond debt. Another 30% is from multilateral institutions. These are rounded numbers, so don't quite add up to 100. And then around 10%, a little bit over 10%, is due to bilateral creditors. So, a bilateral debt relief situation won't necessarily resolve Ghana's problems in terms of debt repayments if it was to run into them. So I think that's the proposal. Now, if that was to gain momentum, then I think it would be very interesting. We'll see when we go next week through the IMF World Bank spring meetings whether it gains. My own inclination at the moment is to say that if you think about it, the big G7 countries, the advanced economies, the US and Europe, really don't have the bandwidth to deal with an African debt redemption program or reprofiling or whatever we want to do until they've solved their own problems. Now that brings you in what you were talking about, the complexities of this. Now I think there is a very real complexity to this. As you say, it's not when we did HIPC, it was mainly the G7, the Paris Club, Japan that were involved in it. This time we have those traditional lenders, we have China, we have some debt from places like India and Brazil, and then we have the Eurobond, the commercial sector debt. So there's a lot more players involved. And of those players, somewhere like China is not a member of the Paris Club or the London Club. London Club deals with private sector debt. So, it's not part of what you would call the global financial architecture. Whether China wishes to develop a new architecture and create the Beijing Club or the Shanghai Club and get everyone on board, well, time will tell. I certainly think what I do see then is that I think that this debt relief, debt moratorium idea might just get pushed down the line at this point. And what we see instead is that certainly for the short term, the next 3 to 6 months, you'll see the multilateral institutions, the IMF, the World Bank, the African Development Bank, some of the smaller ones, the Islamic Development Bank, people like that, stepping up and providing